All right, we'll start in here. Welcome, everyone. I'm gonna let Matt take it away. Thank you for joining us.
Hey, thanks, Kylie and Cy, for putting this whole thing together. Welcome, everybody. Glad you could join us here today. We're going to be talking about an introduction to private real estate funds. This would include all real estate asset-based funds, debt, equity, etc. I'm joined today by Kevin Kim from Geraci Law Firm. Kevin, welcome to the show.
Thanks for having me. Appreciate it.
Of course. I'm actually sitting here in Kevin's office. I'm down in Irvine today, so we're here together, although in separate spots. So it's good to be here. Kevin, why don't you tell us a little bit about your background, give everybody a flavor of kind of who you are and what you do.
Thank you. So I'm the partner in charge of Geraci's corporate securities team. I've been an attorney now 16 years, and I've been working in corporate securities primarily in real estate and finance sectors for my entire career. Former SEC, and in private practice, have been working in fund formation, syndication, crowdfunding, fintech, most of my career. Currently here at Geraci, we offer fund formation services and securities offering services and securities compliance, and also mortgage licensing and corporate formation governance. I'm at this group, and we do that primarily in the world of middle market, real estate investors and developers, along with private lenders and mortgage bankers. It's kind of our core area of expertise. We've been doing this now for 17 years.
Yeah, and Kevin and Geraci Law are well known in the space, the mortgage pool space and real estate space, and one of the leading providers. So happy to have you and appreciate you being on here. So let's dive in. We'll talk about let me give you a quick overview of the agenda here. We're going to talk about the different types of real estate funds, some of public versus private, kind of a little bit about the market, and then what I know a lot of people are super interested in, what investor profiles and motivations and how do people raise capital. Talk about some of the key considerations, should you start a fund? If so, why not, et cetera. And some of the challenges people regularly deal with, which I find are very similar across all the managers that try to do it. And then we'll wrap up with some question and answer. So Kylie's got a quick poll up there. If you can, fill that out as we go, that would be great. And let's dive in. So kind of an overview of private real estate funds. Basically, a private real estate fund, I would define it as it's an entity that is pooling money from multiple investors and is making investments in multiple deals. So whereas a syndication would be pooling multiple investors in a single asset, a fund typically will have multiple assets coming in at different points in time, and investors coming in at different points in time. And they can be closed-ended, they can be open-ended, and so forth. But that is the definition of a fund. So when you see fund structures and asset, it can be any asset class, especially in real estate. I mean, you see the list on the right. I don't need to read them all off, but I would say I've seen in my career literally dozens, if not hundreds, of different types of funds, both debt and equity, different asset class, sub-asset classes, and so forth. Kevin, you want to talk a little bit about the fund structures, kind of how these funds are set up, and kind of what do they look like, and so forth?
Yeah, I mean, generally speaking, when we say the word fund, we're offering equity. Right? So investors are purchasing either a limited partnership interest or an LLC interest in the entity itself. That entity is going to go out and buy and develop and invest in real estate, or it's going to lend on it. That's kind of the general thesis that you'll see in the world of what we're calling private real estate funds. It's usually it doesn't have any employees itself. It's typically going to have a separate operating company that will manage it. It will run the back office. It will be the one facing the investors. It's where you, the sponsor, will be sitting, and it's the one that's earning the fees generated from the income fund. Now, in the world of real estate, generally speaking, you have two big buckets of strategies, right? You have your growth investment and you have your income investment. It's kind of generally across the spectrum of all funds. In the growth sector, you your value add, your ground up construction, and so on and so forth. Your cash flow or income based strategies, you have primarily rental strategies on performing assets. You can have a blend of both. In real estate, the trend has been to do a closed-end strategy, meaning that you have a set amount of money that you're going to raise, a set number of assets you're going to invest in, and a set horizon date in which you're going to wind the fund down these operations. Obviously, you're going to probably set up fund number 2 as you proceed. The logic behind that is it's cleaner and easier for the sponsor to manage, and the accounting is nice and clean. You're not having to worry about lumpiness and value of investment over time, but also it seems to garner less regulatory scrutiny. We've seen a trend in regulatory scrutiny and opening real estate funds. But yeah, the idea is simple in general. The idea of an LLC, right? The thing is that when you're doing this, you really have to make sure you're contemplating securities regulations. If you're doing the investment in loans, you have to consider mortgage licensing. So there's a lot of things to think about. You have listed here a few other kind of, I would call, ancillary strategies that feed into the space. And so fund of funds, master feeder, and umbrella. A lot of these are basically spin-off ideas as opposed to a direct investment strategy, where instead of being the real estate developer yourself, you're saying, well, I like the idea of these different funds. Well, if you're a fund of funds, and you're going to go out and create a fund that invests in other funds. There are unique challenges with this on the regulatory side, about particularly the investment advisor app. Master feeder structures is usually to accommodate non-taxable investors or offshore investors. Umbrella funds are very common lately, especially in the world of series LLCs and also kind of allocation across multiple different portfolios. This is more of an advanced level structure, but it can be done if you have multiple vintages of funds and you want to have kind of a master strategy across the pool of funds that you have. So all good ideas, all can be done, but all have their own complexities.
Yeah, so let's talk a little bit about the difference between equity and debt funds and even a hybrid fund. But you alluded to it there in terms of equity funds, and I find there's a lot of confusion. It's like, what are you talking about? The investments that are being made out of the fund, are they equity or are they debt, or is it the way in which the investor is coming into the fund can also be both either equity or debt, depending on how you choose to structure it. So I think, as the slide talks about, it's really pertaining more to the things that people are investing in. So we'll stick with that since we've limited time. We could really deep.
Well, and that's the interesting part, right? Because the words are used interchangeably and all that. And
that's right.
The simplified thing is, the way I think about it is, if I say the word fund, I'm thinking LPGP, equity based. The context of fund, outside of our world of real estate, hedge fund, private equity, venture, these are mostly LP positions that the investors are purchasing. But the phrase debt fund is being used kind of interchangeably with what I call a note offering, right? Where the investor can purchase effectively it's like a privately offered bond.
That's right.
Where they're lending to the company.
That's
and
right.
This is actually quite interesting for real estate developers who want to raise money, and also may have some challenges in pursuing this scalable finance. It's very hard to pursue leverage that's accretive to the fund. And in those circumstances, a note offering may be your answer, because you can solve the debt problem. And sometimes clients will mix the two together, right? Because when the lack of leverage is, and there's no lack, when there's a lack of leverage, or leverage is too expensive, we saw that the past few years. Combining the two offerings together. So where I, the sponsor, would offer LP positions in my fund, but also offer investor notes where they, get a stated interest rate, quite common.
Yeah, I mean, you can get very sophisticated on how these things are set up, and I've, over the years, we've been involved in a lot of those. I think that, especially as managers are new, it's a difficult concept to grasp, and they only really learn it deeply as time goes on and they execute it. So I think you got to be careful. I always recommend to people, simple is better in the beginning, especially. I mean, as it pertains to equity and debt funds largely, though, and you alluded to it in your comments earlier, equity funds where, now I'm talking that the investments being made by the GP are in equity investments, so the direct ownership of real estate, those tend to be closed-ended. In a debt fund where the sponsor or the GP is investing in loans, let's call that a debt fund, that can oftentimes be open-ended. Can you touch upon the differences between a closed-ended and an open-ended fund, and maybe just high level some of the advantages and disadvantages?
Absolutely. Absolutely. Yeah. So the key difference between open and closed is in the name, right? So a closed-ended fund is going to have, it's going to have a set amount of capital it's going to raise. We're going to raise $100 million over a 5-year window with 2 one-year extensions. And investors are going to come in during a set period. We're going to raise this much money. And at some point in time, we're going to go out and deploy it. And we're going to, process those assets and either liquidate them or we call harvest them. And investors will, not be able to get out until the end of the life cycle of the fund, right? So it's a very closed end when it comes to the life cycle. It's got a set horizon date. It also has a set amount of money it's going to raise. And this works very well in real estate, especially growth-based investments in real estate, because of the fact that you have divergent issues when it comes to the entry of investors, right? And open-ended funds don't work quite well because if you want to simplify it down to a simple concept, the investor that comes in early is going to make way more than the guy that comes in way later in an open fund and that has real estate as the primary strategy. And so it creates troubles on the accounting side. And frankly, I've noticed a trend, regulatorily speaking, that state regulators have been watching them more carefully because there has been an increase in fraud when it comes to those types of real estate strategies. Debt funds, on the other hand, primarily in the world of debt funds, the lenders that are creating these funds are bridge lenders. They're doing short-term loans, right? Short duration, and it's interest producing. So the income source is all interest income, and everything is remarkably uniform across the portfolio, right? Your average, there's not much deviance between the types of loans that you're doing. And so it actually works quite well because there's not a growth-based investment. Everyone's just earning a coupon every year, right? It's not a big capital gain event at the end of the life cycle. And because of that, it can support an open-ended strategy, which has no end to it. You can run it in perpetuity. I have clients that have run their open-ended funds for 15 years now. And as long as you're complying with regulations, you can continue to run it. And by doing so, but in the mortgage realm, it works because the loans are so short-term and so uniform. Now, if you told me that you're doing like, there's been a development in the lending world where clients are doing what they're calling JVs, or they're doing unique kind of preferred equity variations, those might not work for a open-ended fund, right? Or if you're doing some kind of, shared appreciation mortgage, those may not work in an open-ended fund. Or if you're doing long-term paper, those might not work, right? If you're doing, 5-year term, 30-year AM, like term paper, might not work. So it depends on the loan type. But the vast majority of private lenders that pursue debt funds are bridge lenders and construction lenders. And so it works, open-ended strategies work quite well in those circumstances.
I always say to people that you need to make sure that your asset model matches your capital structure. And when you mismatch those at the outset, you basically set yourself up for problems from day one. Hybrid funds, and you also alluded to that, you can do a combination where you have both a note offering and a equity offering, but that gets into the other side. So in the interest of time, why don't we jump to the next slide here and touch briefly on, and I don't get too deep on this one because I think a lot of people kind of have at least a basic understanding, but there's private real estate funds, public real estate funds, and there's, public REITs, private REITs. Can you just touch upon the difference on what are some of the key differences are there, Kevin, between public and private?
I mean, private is your average kind of Reg D, which everyone seems to be kind of, everyone in your audience is probably used to, right? Regulation D, securities exemption, privately offered, mostly high net worth investor. No reporting to the federal government, no reporting to the states. Very little out there is. Public is you're fully registered, right? So you have gone through effectively the full registration process. Your offering has been scrubbed by the commission and approved by the commission. You are likely to be on some kind of exchange, and you have significant reporting requirements to both investors and the regulators, right? Usually will require a higher standard of capital. In the context of real estate, REITs are associated with public offerings, although there are many, many, many private REITs. We do a lot of REIT work here. In the world of funds, we typically see a lot of, more advanced level sponsors pursue public strategies. In the world of interval funds or, publicly registered REITs, but not publicly offered REITs. They usually just want to expand the footprint and increase the liquidity, meaning that they're not publicly offered on any exchange. But one thing that any sponsor should know is that the second you think about going public, your reporting requirements have significantly increased. I mean, probably 1,000 times what you're used to under a Reg D. Not only that, but your unit price, your share price, is now impacted by the market, right? And so, in the world of mortgage, commercial real estate, there have been instances of companies going public. Ready Capital Mark didn't work out so well for themselves, and they sold to Ready Capital. Sachem, these guys have gone public, but if you think about the way it works, is the share price is now dictated by the public market, right? So I don't see a lot of people pursuing this. It's not accretive to their business, particularly if they're the middle market, because there's just too much regulatory oversight.
Yeah, and it's extremely costly. I mean, there are certain appeals to an interval fund, but there's a lot of regulation, compliance, and so forth that have, and I don't see a whole lot of people in the middle market go there. So let's move to the next slide here and talk a little bit about the market. You and I were talking about this for a few minutes before we jumped on, but what are you seeing going on out there in the market right now? I know the last couple of years with the hike in interest rates have been pretty impactful to the whole real estate market and the fund formation market, but what are you seeing out there heading into 25?
Definitely troublesome. Yeah. I mean, obviously we all know office is in dire straits. Office has been in dire straits for some time since COVID. It has no bearing on interest markets have no bearing on that. Just the fact that office is just a very tough investment to be in. Overall, there seems to be there were significant headwinds the past 2 years. Our average real estate sponsor was struggling with capital calls, broken deals, financing term sheets that were being pulled. And most of it boiled down to a significant increase in cost of interest, and lenders had to revisit their term sheets or their commitments. It also led to a lot of struggling real estate sponsors because their loans weren't getting extended when they kind of assumed that they would get extended, and so that created a lot of stress and pressure on the LPs for capital calls. And so we saw a definitive trend away from real estate investment strategies and a significant uptick in debt fund strategies, and even real estate sponsors transitioning into lending. And that, I mean, obviously higher rates, attractive, right? Now, realistically though, there has been a negative impact with the rate environment, even on private lending, because your cost of capital has gone up significantly, right? Interest rates have gone up, institutional price points have gone up. And so that leads to less deals being done. So volumes have kind of tapered downwards. They're tapering back up. But definitely more tailwinds when it comes to being a lender right now. I think most of my real estate sponsors are telling me that they're coming out of the weeds right now, and they're feeling a lot more positive about things. Many of them are inquiring about more opportunistic strategies. Not necessarily like outright distress, but just taking on more opportunistic vehicles, higher risk strategies, and maybe acquiring distressed paper, but not in the context of super aggressive foreclosure strategies. More, listen, the bank owns a bunch of REOs and needs to get rid of them. We'll happily take them off your hands. It's kind of the inquiries that we've been getting lately, but that's only been recent. I would say past 6 months at most.
Yeah,
So
I would say that we've seen
better.
a noticeable uptick in the last few months of people start to feel like, okay, we're getting to a point where we can roll back out in the market. There's some opportunities coming along. Sellers are kind of capitulating eventually, can't hang on any longer. I mean, it's been a rough couple of years. You've seen a significant downturn in the number of new funds getting started. But I think as you enter that next cycle, it's starting to feel like people are kind of getting back in the market and looking to set up new funds. And we're definitely seeing some of that. Well, let's move to the discussion around investors. And I know this is near and dear to all managers' heart, because my experience, both as a many-time manager myself and also an administrator and fund services provider, is that raising capital is generally the most difficult part. Figuring out all the rest of it, people can do, but like, how am I going to raise the money, and how am I going to raise the money consistently? And there's different channels. I find that each of these channels have their own rules to the game on how you do it. And here's like three, I'll call them fairly broad categories on the slide here. But what's your take on how you see your clients dealing with how they go about raising the money?
Yeah, I mean, with number one, it's primarily, it starts out with the client's immediate network. And I always ask the client, can you raise the money directly, at least the first round of capital, the seed round? Can you go out there and do it yourself? And if you can't, you really have to rethink whether this is a good fit for you or not. This funds are not for everybody, right? And so you really have to be, it's raising capital as a skill. And so if you don't have the skill, you got to learn the skill. So but with high net worth investors, traditionally it's a lot less in depth, a lot less invasive, it's more of a kind of a story time investment. It's more of a trust investment in the sponsor. Typically, it's yield driven. Now that has changed in the past few years, where investors, high net worth investors, tend to think they know a lot of stuff, and I always make this joke is, especially with debt funds, is and mortgage, they've seen margin call one too many times, and they and they think that they know all about leverage, and it's like, no, that's not really how this works, right? So that seems to be the approach that we find, and a lot of it has to do with trust in the sponsor and quality of the sponsor, because you're ultimately selling your story. With family offices, small families, it's the same thing. They are a little bit more nitpicky because their directors are typically CPAs. And so they're going to want to see audited financials. They're going to want to see a third-party fund administrator. It's typically the asks, but they're not going to go so deep into the the nitpicky terms and credit risk or that kind of stuff. Where they do get hung up is safety of the investment, trustworthiness of the sponsor. Does it have the bells and whistles that we need to see? Admin and third-party admin and audited financials. The one unique part about family offices is like you said here, is that the estate plan, they're really looking for a nice healthy coupon that's going to last for a while. They're not looking for this massive pop. They understand they know where to get that on their own if they wanted it. Third point, institutional investors, different ball of wax, right? So you have your quasi institutional investors, who I call quasi. You got your life co, you got pension, you got your endowment. They are unique in their own rights. They have their own specific asks. They have their own specific hurdles. Taxes are primarily a big issue with them. ERISA is a big issue with them. But in general, those types of investors also, like their truly, institutional, I guess Wall Street asset manager types, are not going to be interested in commingling with LPs that are maybe family offices or high net worth investors. Life cos may be willing to, endowments may be willing to, but the rest of them probably will not. So that may require a sidecar or a separate fund for them. And typically they're going to insist on multiple years of track record, multiple years of proven, asset quality. If you're a lender, they want to make sure that your loans are bankable. And they will typically be garnering some level of control over the operations of the business, of the investment strategy. Typically, that'll look like a JV relationship where you're truly partnering with them. Is the most common arrangement we've seen so far, because that way they can mitigate their risk and maintain a certain level of oversight over asset management.
Yeah, and I think you can get into a lot of depth on any of those categories and take it a lot deeper. So,
Oh yeah.
happy to have those discussions with people. But so as we kind of get to the tail end of this, so let's talk a little bit about issues that GPs, sponsors, managers want to consider before starting a fund. Kind of, I mean, just general tips on who shouldn't start a fund. Like you mentioned it earlier, it's not for everybody. Right.
No.
There's absolutely not something that everybody should do. You need to be thoughtful about why you're doing it. And just so what are some of the considerations in your mind of what you've seen with managers who have been very successful and those who haven't, and some of the thoughts that they should be having before they.
I would say one of the most important things is, if you're looking to cut corners and looking to do this, if you're looking to bootstrap this as cheap as possible, you're not going to get this done, right? This stuff costs money. And there are very competitive options. I like to think that we are a competitive option. I know Verivest is a very competitive option. So there are competitive options, but the fact that if you think that you're going to be able to do this kind of by the skin of your teeth, you're not going to be able to. And second of all, this is not a hobbyist thing, right? This is a real thing. This is a real business. This is a means to expand your business strategy and do things right. I think those are kind of the most common things I run into early stage when we're doing consultations. But a lot of times also is we get a lot of these sponsors that are kind of, they don't have a clear vision as to what the fund will do. And they ask what I call a kitchen sink fund. They want the fund to do everything and anything they want it to do. And I'm like, you're just going to run into a lot more headaches that way.
Yep.
That trend has gone away a lot. We're seeing a lot less of it, but I still get it on occasion. My philosophy has always been, very, very intentional allocation of investments in the fund. If you want to do, for example, if you're a lender and all of a sudden you want to start go out and buying distressed real estate, do that somewhere else. Build another fund for that. It's not the same strategy. I guess the other thing is it goes to the first point I made, is like kind of trying to truly bootstrap this thing as cheap as humanly possible. That mentality, you're not going to succeed, right? We were mentioning a shared client of ours, Matt, earlier, and like that gentleman, he's down in San Diego. He did it right from the jump, right? He hired all the right parties, he hired all the right experts, he concentrated where he needed to concentrate, and he did quite well. And he's grown very fast. And that goes to making sure that you have talented counsel that understands what you're doing, and also has the resources available to you beyond your legal needs. Second, your back office needs to be hyper strong. So, and you have no excuse in today's market, right? Today's market, in the middle market, every vendor option that the institutions have at their disposal is now here, particularly third-party fund administration. It's now in today's market, I would say it's kind of considered to be standard practice, not even best practice, to have it.
Yeah. No, like 10 years ago, man, when we first started doing all this and first met with you guys, it was like in the institutional world, it's table stakes. You just have to do it. In the high
Correct.
net worth world, like hardly anybody did it at all. Last 10 years, a lot more of people are now doing it. It's more affordable, and it's something that frankly sponsors aren't really, focused on and aren't that good at. Right. So
Right.
why even try to do that? So it's like
Right.
having the right team going in across the board, from legal to CPA, audit, administration, technology, et cetera. You can build a very nice business with a fairly limited number of FTEs, right? Just by hiring the right group of providers. And I think the
Right.
biggest thing to me is like, how are you going to raise the capital? I mean, you better have a very clear idea of what the strategy is. And I find that, to the last slide we talked about, a lot of people have very deep misconceptions about various channels and what the rules of the game are in those channels.
Right.
And you can burn a lot of money very quickly trying to chase various capital sources where you really have little to no chance of it actually happening. So that's a huge piece of it.
Yeah, I get that a lot. I see, I get the statement. I've got a very large social media following. Like I can appreciate that, but have they ever invested with any of your deals before? Have you solicited? Do you know how hard it is to solicit investors and get them through the pipeline and get them to actually commit to you? It's a very challenging process, and a lot of questions are going to be asked, and a lot of things that you're going to have to be ready with your pitch and your docs and your deck and everything else. And so, a lot of folks overlook the how hard it is to raise money.
Yeah, I would agree. So let's wrap up here before we go Q&A. And I don't know, Kylie, do we want people, are we typing in questions? If anybody has any, please enter them into the chat. I'm happy to answer those questions. So, but before we jump to the Q&A, one last topic here, Kevin, what do you think about, I know there's a lot of regulatory and legal considerations, and we won't be able to touch upon all of them, but high level, give us what are the most important things people need to be thinking about when they're thinking about setting up a fund from a regulatory
Yeah,
standpoint?
yeah. I mean, one of the most commonly overlooked issues is like, the SEC's investment advisor regulations, right? And investment company act regulations, not quite well understood. There's a lot of syndication attorneys out there that just know how to put together funds, but they don't really understand the implications of the strategy when it comes to these federal regulations. And there's even more ignorance around it that they don't realize that every state has a version of these regulations. And so one of the things that I see commonly, and we run into this all the time, is that the fund has an allocation in its portfolio in securities, in marketable securities. And like, should you be doing that? Should you be buying and selling securities? Well, if you are, you really got to make sure that you comply with the Advisor Act. And it's a staged process. And without the right thinking through, you may actually end up having to redo your fund entirely because many states don't accept certain strategies. So like one of the, and this can be foot faulted on to a great degree. Like the horror story we had up in Washington, where the client had less than $1,000 of marketable securities in his portfolio, and $150 million fund. State regulator came down, with wrath of God on them, and forced to become an investment advisor. So it's one of those things where you get very careful of how you're approaching those issues. And frankly, the past 4 years, it's the SEC has become hyper regulatory. Hopefully, the election changes that, but they've been really aggressive when it comes to their regulatory oversight. Beyond that, I mean, the nice part is our clients are typically running Reg Ds, and so if you're running a Reg D, you don't have much. You have your ongoing Form D filings, you've got your ongoing Blue Sky filings. Those have gotten so much easier since the advent of the EFD NASA platform. So, it becomes a lot easier. As long as you're staying within the realm of real estate and mortgage, you should be okay. Now, on the mortgage side, obviously, if you're a lender, you really got to think about licensing. Many people have this wrong assumption that, it's commercial real estate, I don't need a license. It's business purpose residential, I don't need a license. That's nothing could be further from the truth. And there are
And that
about
varies by state, right? I mean, that's
every state is different, right? So generally, the advice is kind of west of Texas, you have a lot more regulation, but even on the East Coast, there are random states. So it's state by state. I don't have the time to get through all of them, but just give us a call, we'll walk you right through it.
Yeah, and then even there, you've got judicial versus non-judicial. Now you're getting
Correct.
Into
And there's a lot of missed assumptions. Oh, it's a judicial state, it must be hard to foreclose. That actually might not be true. Like example, in Massachusetts, you can foreclose in 90 days if it's commercial, right?
Yeah.
Even though it's a judicial state. So there are a lot of things that a lot of folks don't understand about the regulations in mortgage, primarily investment, residential, and commercial real estate. So they really have to make sure they talk to an expert.
Yeah, and I would add on top of that, and this is a lot of stuff on the administration side that we help with and people like us help with, but AML, KYC, anti-money
Oh my
laundering,
gosh,
KYC,
so important.
accreditation verification, other things along those lines. I mean, audit prep, valuation issues. There's all kinds of things that you need to be paying attention to. And again, that's part of what
we've had more valuation challenges in real estate funds in the past 2 years than ever before. And then and if you don't have a policy, it won't work.
No, you have to have policy, right? And understanding what that policy is. And to your point, the policy is a lot easier for debt than it is for equity. So,
Yep.
All right. Well, we're getting here toward the end. So why don't we move to any Q&A?
We got some good questions. I like it. All right.
So yeah, Kylie and
Yep.
I
got you. Thanks everyone. Again, if you have a question, just drop it in the Q&A. Our first question, what do you think about Reg A structures for real estate funding?
Gonna tackle that one, Kevin.
Sure. Reg A is a exemption, technically speaking, but it mimics a public offering. So first of all, your legal budget has to be significantly higher. It's a much more complex offering. You have to get approvals from the commission. You have to do consistent reporting. The current policy at the SEC is you have to basically do an annual amendment, do a periodic amendment, and every half year you have to have audited financials to qualify. And right now, at least, the commission is very, very, very nitpicky when it comes to these programs. And so they can be quite creative if you want to build a fintech program or a crowdfunding program. But I always tell new managers, if it's your first offering, I don't necessarily know that it's wise to jump right into Reg A, because the overhead issues, the regulatory issues, if you have a internal attorney or you are an attorney, maybe a little bit easier. But I don't advocate it at the gate. But usually for fund number 2 or kind of next iteration of the strategy, is definitely very accretive.
Yeah, I find that it can be a worthwhile approach there's a variety of reasons that make it good, but it also is much more difficult to execute from a regulatory standpoint. So I'd say Reg D is a lot simpler. Yeah. So, and then a couple other ones here is like, what about starting by being an investment advisor before starting a fund? I would say I wouldn't go out and try to become an investment advisor with the idea that you're going to go start a fund. If you're already an investment advisor, I do see a fair number of investment advisors that at some point decide to set up their own fund because now they've got a vehicle that they can pool people into that vehicle and then place larger sums of money into other vehicles, and they've got the, you know, enough infrastructure and support to be able to do something like that. But I certainly wouldn't go out and try to like, hey, let's start by becoming an investment advisor and then set up a fund. I don't know. What do you think of that, Kevin?
I mean, in the world of real estate, right? So most of my clients on real estate are sponsors, right? They're developers, they're investors, lenders on the on the mortgage side. Yeah, we're trying to avoid that, you know. But if you're a financial services professional and you've been an investment advisor, you've been a wealth advisor for some time, adding these as your own proprietary platform is definitely a very good option, and it's very straightforward to manage. So
Yeah, and here's one from a guy that I happen to know is involved significantly in the blockchain and tokenization space, and I find this a fascinating conversation. But tokenization's been hyped for many real estate investing. Why is it proven so difficult for anyone to leverage the technology?
you have 3 hours.
Yeah, exactly. That's a long
Oh,
conversation.
man.
But I mean, look,
Yeah.
I think in the long run, I could see it being an extremely powerful thing eventually, because like effectively, you know, digitizing the, you know, the holding of that security. I mean, right now, what do people have anyway? They sign a piece of paper
Correct.
that says you own, you know, 2.1% of such and such a vehicle, right? It's like putting that on
Yeah.
digitization and being able to track it on the blockchain theoretically has a lot of advantages. But end of
And I
the
think it's
day,
being done. There are vendors that do this, right? The
yeah,
challenging issue that comes with tokenization is tokenizing the asset itself, the investment itself, is relatively straightforward. The issue that comes with tokenization is that any sponsor that wants to tokenize also wants to create a platform that can support secondary trading.
yeah,
And
then
that's the hard part, right? Because this is number one, you had regulatory hawkishness for the past 4 years, which will change, I believe, in the next, you know, with the next president coming in. But at the same time, platforms are needed to support that. You know, you need technology platforms to support that, and many of them have trouble wrapping their heads around it. And then you also need more vendors. You know, generally speaking, if you're going to do that, you're going to need to partner with a broker dealer. You're probably going to also want to partner with a transfer agent to make things easier on you from a paperwork standpoint. And you know, legal is going to have to be overseeing it constantly. And there are a handful of vendors that do it, but they're very selective in who they choose.
yeah. Yeah, and we've got a lot of questions here. I don't think we're gonna be able to get to all of them, but we'll tackle one or two more. Are they talking about um, fee and expense structure is always a good
Oh yeah.
topic.
Oh
So
yeah.
I know, I mean, both Kevin, you and I have seen, you know, hundreds or thousands of these things. But in your, if you were doing a bell curve, let's say, right, there's obviously the outliers on either side. But what do you think would be a fairly typical structure, say, for a real estate fund or for a debt fund in terms of management fees, and what other types of fees are they charging?
Yeah.
Promote splits, you know, fees,
Yeah.
asset level fees, and fund level fees.
I mean, in general, most folks have been trying to keep their fees relatively moderate because they want to attract investors, particularly emerging managers. The 2 and 20 model has been consistently kind of popular for some time. There's been a shift away from preferred returns or hurdles, particularly on the debt fund side, primarily because of the volatility in interest rate. In real estate, 8% has been kind of the standard. You know,
For,
and then
for a pref, right?
for a pref, yeah. And then, you know, I always tell clients, you kind of want to make sure you capture on the real estate fund side, you want to make sure you capture different streams of income, because you've got your growth income, and even after the property's been stabilized, you're going to hold it for rental. Well, it's going to produce some rental income, right? So you got to make sure you capture both in the right kind of waterfall. But generally speaking, I have to talk high level, the 2% asset management fee, kind of 20%, 30% carry has been remarkably popular and remains to be popular. Lately, we have been seeing a trend back to what we call the kind of fixed rate investment. Like, a investor, you'll make 9% of your money every year, and that's it. That's been relatively popular lately with more new managers, because it's easy, right? It's easy to account for, it's easy to sell, you know, that kind of stuff. It's harder to sell in real estate, in my opinion, but I gotten asks for it. But yeah, I mean, you don't need to overcomplicate it. The biggest issue is more on the fee side, is don't create conflicts of interest with your fee arrangements. And if you're going to make sure you disclose it and explain it, or share the fee income with the investors. So, for example, like on private lending debt funds, origination fees can be viewed as a conflict of interest. And so, kind of lately, the advice that we've been getting from advisors have been, please tell your sponsors to share it with us, and we'll be happy to, think favorably of you.
Yeah, and that's always a tough conversation for a sponsor, right? Because they got
Oh, yeah.
overhead associated with originating and processing and underwriting those loans in the first place. And so if they
100%.
dump all that income into the fund and then only get paid as the fund grows or as part of some sort of split, then it's hard for them to cover that overhead. So it's a very challenging conversation and decision at the
Mhm.
very outset, because ideally you remove all the conflicts of interest, but like unless you have scale, that's very hard to do. So
Yep.
that can be tough for people
It
to
is.
deal with.
It's quite challenging. Yeah. Yeah.
So maybe one more question. See, I got some. There's a lot of them in here, and I'd say happy to engage with folks afterwards on some of those things. But yeah, I mean, 1031 and a fund of funds SPV. I don't know of any good way to do that. Do you have something? I mean, you can do
For in the world of
DSTs.
funds, right, where you're kind of using an entity to pool, 1031, that the rules changed back in 17, so you can't really do that.
Yeah.
DSTs are the only kind of fund
Yeah.
structure that works for 1031, but they come with their own restrictions.
Yeah.
What most clients are doing in that regard is they're going asset by asset, and they're syndicating, and they'll tick alongside the syndication LLC. That seems to be the best, cleanest solution, because 1031 is very restrictive, right? So
Yeah, those are tough. I mean, I found it quite tough to do that. Well, hey, I want to thank everybody for coming, and you see our contact information on the screen, Kevin. I appreciate the time. It's thanks for
course.
the conversation. If anybody wants to learn more about Geraci Law or Kevin, please reach out to Kevin directly. You see his contact info there. And if you'd like to follow along with Verivest, please check out our website, sign up for our newsletter, check it out. You can follow my LinkedIn. Got a lot of activity on LinkedIn, and stay tuned for our next webinar in this 5-part series, which is going to be about what to consider when starting a fund. We have a special guest on from Todd Owens from Cantilever. Met with him when I was back in New York. He runs a pretty good size GP stakes fund, which is a fascinating area of the market that not a lot of people are involved in. So that should be a super interesting conversation. So yeah, and if you have any questions, feel free to reach out to me, someone on our team. We're happy to help. And other than that, Kevin, thanks again for being here, man.
Thanks for having me.
All right. Thank you, everybody. See you next time.
Thanks, everyone.